I think an opportunity to discuss this paper is always welcome, albeit with a sense of mixed feelings, because you almost feel like it's a trap, considering that I'll be getting comments on my paper from probably the same team. So if you see me being overly polite, you can understand where I'm coming from. But I take comfort of the fact that the essence of this conversation is really to enrich the paper. So I'm going to give some set of comments in areas which I think the paper has gone a long way in making us understand the whole aspect of customer satisfaction. And I'll also give a set of other comments in areas where I think the paper needs to be a bit more rigorous, so that it serves the purpose of being a framework around which we understand customer satisfaction. The first comment I'll make is a very positive one, in the sense that this is actually a very important study. It's important because it's an opportunity to formalize the understanding of customer satisfaction, extending that understanding beyond the survey, the polling. I'm sure people from the banking industry know the big event that we usually have once a year, where the winners insofar as customer satisfaction are recognized, and there's a photo op, and you probably see that in the papers, which is a good thing. But this goes beyond there, in the sense that it formalizes our understanding on aspects of customer satisfaction. And why do I say that's important? Because customer expectations drive regulation. I think that's a very important point to note. The banking charter, which is essentially a regulatory document, found its underpinning on the expectations around customer and customer satisfaction. So I think that is one important thing that you probably have to note insofar as why this paper is important. The second is that customer satisfaction drives legislation, even if it's in a manner that is not pro-consumers. Everybody knows the interest rate controls and the clamor around interest rate controls. The excuse behind that was that there was a lot of customer complaints. So understanding the pain points of customers can actually drive legislation. The third aspect is that the consumption of financial services is actually part of the utility function, and I think this paper highlights that fact. So if you have issues of customer satisfaction understood, then you're in a way enhancing what you can call welfare, because the utility function that is underpinned by consumption of financial services technically means that it's welfare enhancing. And finally, I think this is really from the lens of the bankers. A happy customer translates to good business. I think there's no controversy around that. But that depends on whether happiness translates into transaction. Because you can be happy, but that does not necessarily mean that you've consumed financial services. So that's really a big condition. And that's really the distinction that is usually made between the stated and revealed preference. You can state that you're very happy, but so long as you don't transact, and that's really where customer satisfaction is revealed, that notion that a happy customer translates into business may need to be a bit qualified. So I think that is, in a broad sense, why I see the grounding of this paper to be extremely important. The first point I'm going to make insofar as areas where I think the paper needs to start being a bit more rigorous is around grounding it on competition dynamics. The conversation around the fact that intense competition is what is really driving what you can call shifting customer expectations and customer satisfaction is theoretically very important, but I think we need to be a bit more clear as to how that competition is grounded. The way it comes out is as if competition dynamics are so robust to the extent of all the powers being on the consumer side. But I think that's an assumption that can be questioned, in the sense that if that were the case, then I think the competition regulator, that's the Competition Authority of Kenya, will be the happiest organization. But I'm sure you know, and I think this is probably something that you can make reference to in the literature, that there's a lot of debate around competition among us financial service providers. There were attempts in the past to do analysis of the competition dynamics in the banking industry, of course, pointing to the fact that we have fairly robust competition within the bank industry. But the latest one is around competition within the telcos, who are now playing strongly in the financial space. The whole conversation around whether there's a dominant player, whether that dominance reads into poor customer service or high charges, something that I think we need to bring out so that when you're grounding your study on competition dynamics, that becomes clear. And I'll illustrate this as we go along with this conversation. There are two interesting observations that the paper makes, which I think are worth highlighting for purposes of enriching it. The first one is that even within the increase of popularity of mobile banking and technology-related services, there are those who still prefer walking into a banking hall. There's a generation, and I think it's good there are demographics that want to put on a suit when they're going to the bank. So I think the way you look at that is that this emergence of new channels could at best be complementary as opposed to substituting what customers know as it were the case. We actually attempted to do a paper. I co-authored a paper in 2021 around price and non-price competition interactions. And it probably more or less came into a similar conclusion that when you start seeing this emerging of channels, they should be seen to the extent to which they complement the existing channels, up to a point where they mature enough to be able now to start offering what can call substitution effect. So that is one point that I think you probably need to take on board. The other is really how the expectations of customer satisfaction and how it's grounded in literature is premised on three areas, one of which is efficient and friendly services, the other being convenience, either branch or an agent, and of course the reliability on online financial services. I don't know whether you're aware of one measure that the central bank uses to track efficiency, and that is the number of accounts, the number of staff per account. Over time, the central bank has been indicating that because of an increase in the number of accounts per a given staff member in the bank, there's this notion that the efficiency among banks is increasing over time. Of course, that's not a very reliable measure because of the vibrancy in the number of accounts that we've seen with online banking and mobile banking. But suffice it to say that such kind of analysis, and I think much of the analysis that comes in the paper is a bit more restrictive because it more or less focuses the understanding of customer satisfaction from a point of view of either making a deposit or making a withdrawal. So I think that is something that I think you probably may need to take on board. And the other is that the account number do not in any way indicate the value of the transactions involved. So when you're looking at efficiency, maybe the paper can be a bit more clear on what measures of efficiency they're talking about, so that when you have customer expectations being measured, then you're very clear as to whether there's an improvement, and that leads to having satisfied customers. I see that actually as an inherent limitation that is similar to what we see in the surveys that are being undertaken around financial inclusion. In the sense that you may think that you have a satisfied customer, just as we assume that you have an included customer, or that inclusion is simply at the touch point. Am I able to log into my bank account? Am I able to make a withdrawal deposit? Yes, that's important, but the crux is what does that translate to in terms of the value of transactions and whether you have an opportunity to consume the full array of the menu of products that a bank is able to offer. So I think that is an issue that I thought the paper can highlight further. The fourth area where I think I need to have a set of comments is around, why I think this paper, much as it's an enhancement of the surveys, probably need to be a bit more The first one is really the analysis. It didn't come out in the presentation, but it's in the paper, where you're basically tracking the customer journey, essentially grounding the analysis of the paper in what they're calling pre-utilization, interaction with the services, and after utilization, which is a good thing because then you're able to cover the entire customer journey. But the empirical side of it comes a bit of complications because pre-utilization simply means that no, this is really at the marketing stage. And that is essentially, it may not necessarily be your customer. How you're able to capture that in a study like this, where you're doing a survey of bank customers, it's probably something that you may need to think much clearly about. So essentially, the richness of the customer surveys that are released on an annual basis and how they fit into this is that, ex post, you can actually take advantage of the feeling that customers get by being associated with a bank that has been ranked highly. Then from there, you see how they come into being customers. Before then, you start looking at how you can assess them, whether they're satisfied or not. But pre is a bit more tricky to capture in the paper. And I think probably that's the reason why it didn't feature prominently in the empirical analysis. The other is really what you can call post or after utilization. The assumption right there is that, this is probably a customer who has been dissatisfied and has exited. So if a customer has not exited from your bank, it simply means you can make an assumption that is a satisfied customer. So how you're able to track that is also an interesting phenomenon. So much as you may want to be ambitious and track the entire customer journey, there are those two aspects of before you become a customer and after you've exited as a customer, and how that will really be captured in your analysis. The proposal I'll make there is that, probably you need to complement this survey that is really very customer focused to a survey on among as the banks themselves, so that it can give you the experience insofar as their customer, the expectations of their customers are concerned. Because then that will mean, instead of looking at it from the demand side, you're also able to bring in the supply side in terms of what do banks tell you in terms of the experience with their customers and how have they been tracking the customer satisfaction over time. So I think that is something that you may consider putting in the paper. The other is really around the modeling aspects, and I think I'll go a bit lighter on this in view of Habil's comments in the morning around, the authorship of this paper being unique, and I think with a view to encourage it. I like the fact that, you've specified at a broader level your model to be, a bank customer satisfaction as a function of what you can call customer-specific attributes and bank-specific attributes, and also what you're calling customer preferences, bank customer preferences. What I didn't see much in the analysis is really what you can call a careful consideration of what you're calling the bank-specific attributes. You may have made an assumption that, by specifying which channels, you've actually identified what you can call bank-specific attributes. To my mind, that will not be sufficient because many of the aspects that you've highlighted as channels are essentially across the board. I think there's no bank that doesn't offer online or mobile banking. And I think there's no bank that doesn't have a branch. I could have expected, at the very least, you start looking at banks in terms of, maybe their sizes, because the bigger the bank, the more the challenges it's confronted because of the wider base of their customers. You probably could have looked at the banks from the context of whether they are retail-oriented or corporate-oriented or a mix of both, because customer expectations differ depending on whether you're a retail customer or a corporate customer. And I think much as the paper says that it's leaning more on retail customers, I think it cannot be a complete story unless you start looking at how you can embed corporate customers. And I think this is another area that you probably can consider stretching the paper going forward. And I think there's a gray area that maybe would be interesting to consider as you go ahead. And the gray area is around the aspect of in between, where you have a retail customer converting the resources that are accessed from a financial institution to a business. And the reverse is also true because they can move business resources into what you can call consumption. those customers have unique attributes other than what you're considering to be your usual retail customer, whom, according to this study, is simply utilizing financial services from that very basic standpoint of either deposits or withdrawal. So I think that's a nuance that could be important to bring across. So essentially, the aspect of bank-specific attributes is somewhat missing in the conversation that we're having here. So with that then, I'll propose a few things. The first is really the need to be to have a conversation around the choice of the sample that you're using in this paper. You actually mentioned that you've done what you call a random sample, and you give advantages of going a random sample amongst the data points that you have using the surveys over the period. The challenge with that is unless you recognize the differences that are arising from these bank-specific attributes, a random sample may not necessarily be the most ideal, much as you highlight that it has advantages. I could actually suggest that probably a stratified random sampling where you identify the unique aspects, whether it's size, the customer focus, and then from there you do random sampling within those stratas that you identified in the study. The other is really to look at the judgment that one can make with regard to market power. And this is the point I made earlier regarding dynamics of competition. I think the whole idea of the evolution of bank customers and their ability to be shifting from being multi-banked to single bank is a very interesting observation. And I think if you look at the years that you've tracked, you tend to see that those who have been having multiple banks have come down, while those that have been having a single bank have been going up. And there's almost a balance over a very short period. That may be inviting you to make a conclusion that people are necessarily moving towards a single bank. But I'll be a bit more careful in interpreting that trend like that, because there's a reason why people go into more than one bank. And that would be probably the range of products that are offered. You find that there's a product that has been tailored in a certain way that is offered in a certain bank that is not available in what you can call your primary bank. So at the future point, it would be necessary to determine what you can call the optimal number of banks that a typical household or typical business will have, even at the retail point. I know for a fact that corporate customers, particularly the big ticket corporate customers, are usually multi-banked, and that's not seen as a problem. So I think determining the optimal number of banks that a customer will have is something that maybe this study will indulge going forward, this being a foundational study. And I think, to my mind, the whole idea of being multi-banked doesn't have to be necessarily seen as a negative thing. It simply means that the market is being dynamic enough to allow customers to have a wider choice. Of course, a bank will prefer their customers to be in one place, but I think that could be a signal of market dynamics. In terms of the conclusions, I think some of them are fairly obvious and could be expected given what this survey has highlighted. And that's why the study easily comes to conclusions around aspects of product design or channels, as we refer to them. The whole aspect of accessibility, which I think is very critical, because if you're talking about customer satisfaction, then I think you probably have to look at it in the context of customers not being disenfranchised because of either disability or any other thing that makes them not be able to access financial services. But I think that also has to be seen in a nuanced way, because some of these things are not necessarily the choosing of a bank. Some of them could actually be regulatory issues and therefore non-competitive issues. For you to have a ramp in a bank and therefore allow a disabled person to access a banking hall is a good thing, but it's not a competitive thing, it's essentially a regulatory thing. And therefore bringing out those salient characteristics where you're either complying to a law, such as consumer protection laws, or to a regulatory requirement, is something that I think should be important to infuse into the paper and therefore enhance its richness. My final comment is around really stretching this analysis beyond the touch point of either I'm able to transact online, I'm able to withdraw, I'm able to make a point. And this to me is really trying to see how this can go beyond those two and include aspects of pricing, for instance. The reason why I say that is because many customer complaints are around pricing. And I think the whole thinking around things like coming up with APR, which is a very critical tool, is around enabling the customer understand the pricing dynamics. Because pricing is so critical to an extent, is really the source of not just complaints in the bank industry, but the source of litigation between banks and their customers. And by embedding the aspect of pricing, then you're looking at customer satisfaction from a very holistic standpoint, allowing them, the customers, to be seen from the context of them transacting in a manner that now makes both business sense and makes us understand the whole aspect of customer satisfaction in a broader context. I think with that, I must conclude by saying that this is a very strong foundational paper, and it provides ground for further work to be done in a continuous process of understanding what customer satisfaction is all about. And I thank the authors for the good work. Thank you.